One of the areas that a lot of us find difficulty with is that of coping with our financial matters. And our guest today is one of Canada's top exponents on how to deal effectively with our finances, and that is Brian Costello. He is the author of a book, Your Money and How to Keep It. And Brian, in so many ways, you've got to say that is a captive title, and people would want to know, are you really able to give the answers simplistically so that for the average layman we can understand how to keep our money? Because taxes rip us off so much of the time.
Well, I think, Brian, they rip us off because we let ourselves be ripped off. You know, I mean, let's face facts. We don't know much about money. We're used to spending our time earning it, not keeping it. And that's why the title of the book, I mean, Your Money and How to Keep It. Everybody in the past was so content just to earn it because inflation was low, taxation was low. But have you seen what happened to taxation lately? And what happened to inflation a few years ago? So it started to rob us. And the worst thing is the combination of the two. The combination of taxation and inflation means that most people fall behind. So we have to work just a little bit harder. And if I can tell you something that maybe a lot of people don't realize because they don't bother to calculate their tax situation. The average Canadian pays 54% of his or her taxes to one government or another. That's federal and provincial income taxes, and then sales taxes and property taxes and the sin taxes. Do you know that means you go to work in the morning and you work right through until just after lunch for the government? How come we all bugger off in the afternoon? We just started working for ourselves.
I'm sweating. You're talking like this is making me nervous. Listen, could you please answer one basic question? You know the song, the rich get richer and the poor get poorer. I want to know, as a regular old Canadian who's been around for a few years, who's who? And before I die, I really think I deserve to be told, am I rich or am I poor? So would you be kind enough to, is there any law, any median somewhere, like who falls into what?
You want to figure out if you're going to get all set for Leach's show, The Rich and the Famous. Lifestyles of the Rich and the Famous.
I want to know what my kids are going to get when I kick the bucket.
I dare say they do as well. Brian, how can the lady know if she's rich or poor?
Is your name Bronfman?
What if I said yes?
I say either you're rich or at least you're working towards it. That's a common question that I get, not phrased as well as that, but it's a common question that people now all of a sudden want to know what's going to be left, whether they are rich. And it's not, there's no number to say whether you're rich. It's not how much you earn, it's what you get to keep. We have lots of people that are earning $55,000 and $60,000 a year, no tax, because of constructive money management. We have people earning $100,000 and more because of constructive money management. But they're not necessarily rich. But there are lots of people who are the average individual. And let's take the average individual in Canada is in the 35% tax bracket. That means that on their last dollar of earnings, they pay 35 cents to the tax department. That's income taxes. Forget about the other taxes. Those people are poor because they're trying to be richer, but in fact, they can't compete with the tax man without the help of a professional. They should get a professional, because that person who's earning 35% tax bracket, that's the natural target for Revenue Canada, for the provincial tax man, for every tax man, because that's the masses. It's a lot easier to get a couple of dollars from you and a couple of dollars from me than it is to go out and get $100,000 from the Bronfmans or the blacks or somebody like that. So you're going to be the target. So you should be taking advantage of every tax shelter you can and practice what we call a three-pronged attack. That is, instead of doing what you probably do in your lifetime, as that is earn the highest yield you can find, you should get a tax deduction first. Get a tax deduction first. Then earn the highest yield you can. Then we'll show you how to get the money out of that investment tax-free. Then you don't have to pay the government back.
Do you want to give us an example of what do you mean by a tax deduction?
Well, I mean, the natural one and the easiest one for everybody to use is the registered retirement savings plan. Yet, 35% of the people use them. Why not 100%? It's because they don't understand that it's a tax deduction that counts here. We've all been used to, say, trying to put our money in a bank or a financial institution, trying to earn a little bit of income with it. But I have to tell you, that's no longer the game. The game is now to save taxes, then take the taxman's share plus your own share and earn some income.
Brian, let's take a break and we'll find out how we can do that more effectively after we come back from this commercial. Thanks. Before we took the break, Brian, we were talking about tax deductions. And one of the I think hard things for a lot of people to understand and perhaps even believe is the statistic of, you know, the lady was talking a little while ago about who are the rich and who are the poor. The old statement that the rich don't pay taxes. What sort of, I don't want to say background, but what sort of, I think the word would be impression, is there about the rich and their payment of taxes?
Well, I think that that people feel that the rich get to keep substantially more of their money than say, to the poor. And that's, in fact, probably true because they in fact, can pay a professional and they can use the sophisticated tax shelters. But I have to tell you, everybody out here could earn $40,000 a year tax-free if they had the resources to produce the dividends. We all have a tendency to buy Canada savings bonds, term deposits, something that produces interest income. Well, that's all taxable income. Yet if you earn dividends, that is, if you say, well, I'll put my money in the stock market, then I could earn up to $40,000 or so tax-free. But a lot of people don't want to take the risk that's involved with the stock market.
And what's the percent of people who play the stock market and succeed?
Well, the percent of people who play the stock market on a long-term basis, I would say would be 100% would be winners. See, what happens with the average Canadian who doesn't understand or doesn't use a sophisticated tax, you know, like a stockbroker or a financial consultant, those people, when the market starts to fall, they sell. But when the market falls and you have a good professional, that's when you buy. You see, so you always go opposite the trend. And if you go that way, then you'll be buying today, you'll be holding for a long period of time. And I can tell you right now, that on a simple example, if you put the maximum into your registered retirement savings plan every year that you could from back in 1967, our centennial year, you would have up until now put in $78,000. Had you put your money into a savings vehicle, you earned about $140,000. Had you put your money into a term deposit, about $189,000. Had you put your money into a short-term money account, like 30 days or 60 days, you have $199,000. But if you went for a mutual fund and just left it there, you forget about the ups and downs, just leave it there, you have more than $400,000. And yet you didn't pay 1 penny more for that mutual fund than you paid for your term deposit. So it's what you do that counts. But the average person says, I'm going to lose in the stock market. You don't if you go there for a long, long time.
Okay.
You should have asked me that question. I give a course on investments, and this is a problem that we encounter precisely. Brian, I wanted to ask you, isn't one of the reasons that people are reluctant to actually pay professionals for financial advice is that everybody thinks they're getting free financial advice from a bank manager, an insurance broker, a stockbroker, none of whom are truly objective?
Well,
they're all selling products in a sense.
I think that I have to agree to a certain extent, because if you go to a life insurance person, he doesn't want to sell you real estate. He doesn't get a commission for that. He wants to sell you the stock market. He wants to sell you his life insurance product. If you go to a banker, bankers, if you recognize what a banker is simply a person who raises money by attracting your deposits in and who makes money by lending the money out at a higher rate of return. So they have an axe to grind. If you go to a stockbroker, the stockbroker definitely wants to sell you stocks or bonds or mutual funds or options or whatever. But if you go to somebody who is involved in the whole bailiwick, if you go to a financial consultant or a financial planner who absolutely either doesn't sell anything, just charges you for your time, or sells everything there is, then I think you'll come out without somebody trying to sell you one particular product.
Okay.
Bearing in mind that we all want to minimize our taxes, we live in a wonderful country and we have a lot of services, especially considering the population. Are our taxes really too high?
I don't think there's any question that our taxes are too high. Our taxes are just way out of whack. I mean, let's face facts that the average person here might pay $5,000, $7,000, $10,000 more tax here than they would in the United States.
It's just have all the same services if we had lowered taxes. I know there's probably waste and inefficiency, but
well, I think that we could. In fact, I designed a tax return that I thought that the government could use, but they chose not to. And it was a 4-line tax return. It says at line 1, I earned this much. Line 2, I spent this much. Line 3, I have this much left. Half of it's yours. You know? And while that would have given them just about as much money, the trouble is it would have put a lot of politicians out of work. So they didn't like the idea. But there's no question. We end up paying far too much tax. And the reason why is because the government has become prone to wanting to give things away. So many times the government offered, I mean, let's face facts, that almost everything that's offered as an incentive was created by somebody lobbying the government. And so if they lobby the government, and then they give it away. So now we're paying for all that, but how many people use it? How much does it cost for the bureaucracy to run that program? Get rid of all those things, and we won't spend nearly as much tax, and I'll bet you we'll have a better economy.
Okay.
I believe in long-term, low-risk investment. How come that in the last few years the trust companies are much more competitive than the banks, and my results are much, much better with trust companies than with banks?
Well, I think that with the deregulation of banks and whatnot, we finally now have a much more competitive nature. I mean, we have the banking industry really controlled the place, okay? Then we have now the trust companies are much more competitive, the credit unions, the case populaires. They're now out there competing for the business. And because they're competing for the business, they find that they can attract us in. I mean, I don't care if a new trust company opened tomorrow and I was looking for a term deposit, I would have no qualms about putting my money there because I'd have the deposit insurance. So on that basis, you can go for the little small company, get a better rate of return. But the big company says, holy smokes, I'm losing that business. So the big company now says, I guess I better become competitive. Remember when we had no regulation, we had total regulation in the airline industry? I mean, Air Canada couldn't make any money. You bring in deregulation where prices fall, how come they made money all of a sudden? Because competition takes you to take your money out of the big ones and put it with the small ones. The big ones now have to attract you back.
Thanks, Brian. We're going to take a break, and we'll be right back.
Interest. Can you tell me what you think of real estate as an investment for the ordinary Joe?
Well, I think it's a cornerstone. There's no question that people should be they should be looking at real estate. Let's face facts that there are three things you should own, and they are real things. I mean, I think that you should own some real estate, especially a principal residence. I think you should own some stocks, and I think you should own some mutual funds. Those are the three things. And I don't care what order you take it in, because some people don't want to be a landlord. Like when it comes to owning a principal residence, you should always do that, and you should always pay your mortgage off as fast as you possibly can. When it comes to owning something like a second property, like a cottage, remember now that without capital gains on most of the gain that you earn, this property is just going to rise in value. Okay, but you always pick a good location. That's especially when it comes to a rental property, because you'll want to sell or you want to attract a good tenant into that rental property. When it comes to the getting the money for it, I have no qualms about borrowing to buy rental real estate. Because if I borrow to buy rental real estate, I know that the interest will be tax deductible. And if the interest is tax deductible, even if it's greater than the rent that I have coming in, now I get a tax deduction against my ordinary income. And I have a lot of people who borrow 100% to buy the property. And I'm not talking about any of these fast-moving ideas that you see out on the street. They'll maybe buy a normal rental property, take a 75% mortgage, which is the standard mortgage, but they will go out and take a personal loan to raise the other 25%. And in fact, if you do that, you now create a tax deduction. That saves you taxes against your other income. And that's what we tried to do. Get a tax deduction, get the highest yield, and then get the money out tax-free. Well, once you sell the real estate, it comes out tax-free.
Okay.
Why would I pay the mortgage off? Well, that's a question that that I get regularly. Why should somebody pay their mortgage off? And I have to tell you that we use a cardinal rule. We always pay off all non-tax deductible loans. Because if we can pay off the non-tax deductible loan, then we're not paying money out of our pocket that is after tax. But when it's a rental property, I probably don't pay off that mortgage.
Okay.
Brian, I was down in Rio de Janeiro over the Christmas holidays, and I bought a condominium for some $40,000 Canadian. And my question is, we bought this condominium actually for a very reasonable price. And if I sell that condominium, you can't buy a 1.5 bedroom unit for very much in Florida for that price. What would be, if I sell that at a profit, would there be any tax here in Canada to pay there?
Unfortunately, no, there wouldn't be. I say unfortunately because I think it's a shame that people should be able to take their money out of the country and profit and not have to pay any tax here. I think that that if you earn a capital gain in Canada, that is, you buy something for one price and sell it for another, that you should in fact get tax relief. That'll help the economy along. That'll improve our economic situation. But when you take your money and you invest it outside the country, I think you should have to pay tax on it. In quite fact, though, you would not have to pay any tax on it. There's no capital gains even for foreign investments.
So you mean to say that if I invest in any foreign area, I don't pay tax on it?
Well, based on the legislation from the capital gains that was introduced in the May 1985 budget, in fact, Brian, no, there's no tax. Doesn't matter whether you buy art or antiques or foreign real estate or Canadian real estate or stocks or bonds. There's no tax. And that's why we should buy things that rise in value, rather than simply leaving our money in a savings account or Canada savings bonds or term deposits.
Okay, Brian, you've got a number of people who may be watching the program, and they wrestling with the idea of whether or not they should be buying their first home. And they're looking at the interest rates and how the interest rates have gone up, gone down, and they say, what's the right length of time for me to be involved in my interest rate for the length of time for the mortgage?
Okay, first of all, I agree with what they're thinking about doing. Buying a house, yeah, I don't think there's any question that we should own real estate. This is going to be a very good market for real estate for a few years yet. As to the mortgage, we personally believe that interest rates are too high. As inflation falls, interest rates almost always fall. So in this case, I would have to say that inflation's going to fall as oil prices are falling. So I would be taking an open mortgage or a 6-month mortgage or the shortest term mortgage I could get, because I believe when that mortgage is renewed that the interest rates will be lower and you'll come out ahead. However, at the same time, I would pay extra against a mortgage. Like if I went to a lender and said, what is the monthly payment for a 5-year mortgage and what's the monthly payment for a 6-month mortgage? I would say I want to pay the 5-year monthly payment, but I only want the interest to run at 6 months. Now I'm paying too much. I'm paying the excess against my mortgage. I'm paying it down.
You have a curious concept when you talk about the weekly mortgage. What's that?
That's a ripoff. The weekly, I don't. I shouldn't make these carte blanche statements. I mean, a weekly mortgages can be a ripoff, but weekly mortgages are most often a ripoff because people take their house and they switch from one lender to another, and they pay $600 or $700 in fees to switch. Almost exactly, this is how a weekly mortgage works. If you have a monthly mortgage of $400 a month, the lender divides it by 4. 4 into 400 is $100 a week. Well, $400 a month is $4,800 a year. $100 a week is $5,200. That's $400 extra. A weekly mortgage is effectively the same as a 13-month mortgage payment. So just make one extra mortgage payment a year. You have the same. You don't have to pay the $600 or $700 to move to another company.
You look at individuals who are watching the show and they are loaded down with the weight of their credit cards. And there they are, and they're paying a colossal interest rate. And they're saying, okay, how can I effectively get out of this and really begin to pay strong money against my capital, as well as lightening the load on the interest?
Well, I think that some people should take a machete to them. You know, I mean, let's face facts. A lot of people fall into the trap of using these things to borrow money. That's what you're doing. When you don't pay your bill, you borrowed money. Now, interest rates right now determine that a loan should be running at 12 or 13 or 14%. But in fact, credit cards charge 18 to 24%. And they compound it monthly. So you're really paying even higher rates than that. I have to say that what you should do is just take the credit card, say, how much is my balance, go right back to the same institution where you got the credit card, and borrow to pay off your credit card. You're going to borrow at 14 to pay off a 21% loan, you're winning right off the bat. Then start to manage them a little bit better.
And then use the machete.
Then use the machete. But don't put them away in a safety deposit box until you catch up on them. Then start to use them constructively.
Thanks, Brian. We'll be back just after this commercial break. Thanks. The point that people might be interested in knowing about, how is it that you go about making your mortgage tax deductible?
I find that a lot of people, in fact, could make it tax deductible without calling an election, of course, because we were promised it at once that we were going to get that. Effectively, if you were to have a mortgage, but you also had some investments, lots of people make the mistake of hanging on to both of them. You should cash in your investments and pay off your mortgage. So now you have no investments and no mortgage. And you know something, if you then put a mortgage back on the property to buy back your investments, the tax man is prepared to accept that that's not a mortgage to buy a house, that's a mortgage to buy investments. And in fact, all investment loans, the interest is tax deductible in Canada. And there are a lot of people out there who are in this position who just don't use it. That's what a professional can do to help you out. So crisscross the loans, you'll come up with a tax deductible mortgage.
So it really profits people to get in there and get a good business consultant to help them out. Okay?
all these wonderful figures you see on past performance in mutual funds for people who've never bought before or don't really understand them, can we expect them to continue in that magnitude of performance, and would now be a good time to start buying?
Well, I think that past performance is a criteria that you have to use. There's no question that if you go out and say, what'll the future hold? I can't promise what the future will hold, but what I can say is that if you look at an 18-year or 10-year or 15-year or 20-year past performance, and you know that especially in the last decade, we went through two of the worst times since the 1920s, and yet mutual funds still paid 18 to 20 to 25 to 30%. So I think that if the company you're looking at, in fact, performed well in the last decade, in spite of the ups and downs, that I think, in fact, that it will perform well. It has the management that's needed. However, when it comes to saying, is this a good time, I think there's no set good time. You can't say, I'm going to buy today and sell tomorrow. You have to say, yes, today's a good time to buy because 10 years from now I'll make a profit. But don't ever think that you could buy today and sell tomorrow. These are long-term things.
Brian, you've got somebody watching the show, and they're somebody who's over 65 or whatever the age is, and they're on a pension, and they're wondering, well, you know, all that sounds tremendous for people who are earning a steady income. How can I turn my category into a money-making, tax-saving situation?
Oh, I have to tell you, pensioners in Canada do it wrong. They do it wrong. They think that once they get a little bit older that they have to then automatically switch to Canada savings bonds or switch to term deposits or something. There is something that's called a withdrawal plan. And that withdrawal plan allows you to, say, buy an asset or a long list of assets and sell them off systematically so the money comes back to you tax-free. The other thing is that the professional managers use a stock market portfolio or a mutual fund portfolio where you take all your money and put it into it, and then you systematically remove the money over the rest of you get back part of your own money, which is tax-free, part capital gain, which is tax-free, part dividends, which is tax-free. So don't just automatically think that you have to switch to Canada savings bonds or whatever. In fact, you could buy a duplex and rent it out. Now the duplex rises in value. Somebody else's rents always rise in value too.
Okay.
One thing you haven't mentioned is gold. Should one still have gold in one's portfolio?
Personally, I find gold to be a useless investment. You can't eat it, can't live with it. Some people can't live without it, but I find there's so many better investments. But you can have a little bit of gold in your portfolio, you know, just a little bit of it, because if you have a little bit of it, then you'll have protection against inflation. But gold doesn't pay dividends. Gold doesn't pay anything other than a capital gain, and lately it hasn't been rising, has it? So you
say, Brian, you put on the stock, and somebody wants to know the best investment on the market now. What, if you were given an X amount of dollars, what would you invest in right now?
The absolute guaranteed best investment is a parking ticket. The longer you hold on to it, the more it's worth. If I had a set amount of money right now to invest, the first thing I would do would be I would be putting my money the maximum into my registered retirement savings plan. I would be paying down my mortgage because it's a non-tax deductible mortgage in most cases. Then I would be looking at taking my money and putting it into something which was a very long-term investment, either real estate